Warren Buffett, the only 5 dividend stocks I'd buy before the next recession. Let me tell you something that most people don't want to hear. A recession is coming. I don't know exactly when. I don't know exactly how bad it will be, but I know with absolute certainty that another recession will happen. It always does. And when it does, most people will panic. They'll watch their portfolios decline. They'll read doom-filled headlines. They'll sell at the worst possible moment. But here's what I've learned after investing for over 70 years. The investors who get wealthy aren't the ones trying to time the market perfectly. The wealthy investors are the ones who know exactly what to buy when fear is at its highest. And here's the beautiful thing about recessions that most people miss completely. They don't actually stop the best businesses from operating. The best businesses keep running. They keep generating profits. And if those businesses pay dividends, they keep putting cash in your pocket month after month, quarter after quarter, even while the stock market is in free fall. That's why today I want to share with you something that could change your financial future. I want to tell you about the 5 dividend stocks I would buy right now before the next recession hits. These aren't speculative plays. These aren't high-flying growth stocks that evaporate the moment the economy hiccups. These are businesses that have paid dividends to shareholders through every recession we've seen in the last 50, 60, even 70 years. These are the kind of businesses that actually do better during downturns because they have strong balance sheets, loyal customers, and business models that don't rely on good times to generate profits. The thing about dividend stocks is that most people completely misunderstand them. They think dividend stocks are boring. They think they're for retired people who want steady income, but that's actually exactly backwards. Dividend stocks are for people who want to get wealthy. Here's why. When you own a dividend stock, you're not just hoping the price goes up. You're getting paid to wait. You're getting cold, hard cash flowing into your account while you hold the stock. And when you reinvest those dividends by buying more shares, especially at lower prices, during a recession, you create a compounding machine that can generate absolutely extraordinary wealth over time. Let me take you back to 2008 and 2009 for a moment. The financial system was on the brink of collapse. Markets were down 50, 60, even 70%. People were losing their homes. Unemployment was skyrocketing. The news was uniformly terrible. And you know what? Some of the highest quality dividend-paying companies barely cut their dividends at all. Procter & Gamble kept paying. Johnson & Johnson kept paying. Coca-Cola kept paying. And you know what happened to the people who kept buying these stocks at depressed prices, who kept reinvesting their dividends, who had the courage to stay the course? They made fortunes. By 2019, those positions had compounded into absolutely spectacular returns. But it didn't happen because they were clever. It happened because they owned great businesses and they stayed disciplined. Now, I want to give you a framework for understanding which dividend stocks deserve your money and which ones are just traps. Because not all dividend stocks are created equal. Some companies pay dividends because they have more cash than they know what to do with. Some companies pay dividends because their business is so stable and profitable that they generate consistent cash flows year after year. But some companies pay dividends because they're slowly dying and they're just returning capital to shareholders while their core business crumbles. You need to know the difference. The first thing I look for in a dividend stock is dividend history. How long has this company been paying dividends? If a company has been paying dividends for 20, 30, 40, 50 years and through multiple recessions, that tells you something incredibly important. It tells you the company understands how to survive. It tells you the business model is fundamentally sound. The best dividend stocks aren't just paying dividends today. They've been paying dividends through wars, through recessions, through technological disruption, through inflation spikes, through all of it. And they didn't just maintain those dividends, they grew them. That's what you're looking for. Companies that have increased their dividends every single year, sometimes for decades on end, that's the mark of a business that's not just surviving, it's thriving. The second thing I look for is something called dividend yield. But here's where most investors get confused. A high dividend yield can be a trap. If a company suddenly starts yielding 7% or 8% or 10%, when it normally yields 2 or 3%, That usually means one of two things. Either the stock prices crash because there's something wrong with the business, or the company is unsustainably high on dividend payments and is about to cut. What you want is a company with a reasonable, sustainable dividend yield, something in the 2 to 5% range paid by a business that's generating massive free cash flow. That way you know the dividend is safe and can actually grow. The third thing I look at is the dividend coverage ratio. This is a number that tells you whether the company is actually covering its dividend payments from its earnings. If a company earns $10 billion and only pays out $3 billion in dividends, that's excellent. That company can handle downturns and can even grow dividends. But if a company is earning $10 billion and paying out $12 billion in dividends, that's a problem. They're eating into their cash reserves, and that's not sustainable. In a recession, when earnings decline, that company will be forced to cut its dividend. The companies I want to own have dividend coverage ratios that are comfortable, usually between 30 and 60% of earnings going to dividends. That leaves room for downturns. That leaves room for growth. That leaves room for financial flexibility. The fourth thing I look at is the quality of the business itself. Does this company have pricing power? Can it raise prices when costs go up? Does it have customer loyalty? Will customers keep buying even if competitors offer cheaper alternatives? Does it have recurring revenue? Does it generate real cash flow, or is it just accounting profits? The best dividend stocks combine reliable cash generation with businesses that have enduring competitive advantages. These are the kinds of companies that can actually increase their dividends during recessions because their cash flow doesn't decline the way other companies do. With those criteria in mind, let me tell you about the 5 dividend stocks I would buy before the next recession. The first one is Procter & Gamble. Now, I know what you're thinking. Procter & Gamble, that's a boring consumer packaged goods company. How is that exciting? But that's exactly the point. Procter & Gamble is boring on purpose. The company makes detergent. It makes shampoo. It makes diapers. It makes toothpaste. It makes razors. These are products that people need to buy regardless of economic conditions. During a recession, people don't stop washing their clothes. They don't stop washing their hair. Babies still need diapers. This is the kind of business model that's recession-proof. What most people don't realize is that Procter & Gamble has been paying dividends for over 130 years. Over 130 years, the company has increased its dividend every single year for over 60 consecutive years. Think about that. Through the Great Depression, through World War II, through stagflation in the 70s, through the crash of '87, through the dot-com crash, through 2008, through everything. This company has not only maintained its dividend, it's increased it every single year. That track record is almost unmatched. The business generates incredible cash flow. Procter & Gamble makes over $30 billion in cash flow every year. The company spends money on marketing. It spends money on research and development to create new products and improve existing ones. It invests in supply chain and distribution. And after all of that, it still generates enough cash to pay dividends, buy back shares, and pay down debt. The dividend yield is around 2.5% to 3%, which is sustainable. The company is not paying out a crazy high percentage of earnings, which means there's room to grow the dividend even during downturns. The competitive advantages at Procter & Gamble are significant. The brand portfolio is extraordinary. Tide, Crest, Gillette, Pampers, Ariel, Dawn. These are brands that people trust. These are brands that people have been buying for decades. Switching costs are real. Once a customer finds a laundry detergent they like, they keep buying it. If you need diapers for your baby, you tend to stick with a brand you trust. The company also has scale advantages. Procter & Gamble has distribution networks that competitors cannot replicate. The company has manufacturing efficiency that comes from producing billions of units of product every single year. If a competitor wanted to build a competing laundry detergent business, they'd have to convince customers to switch from products they've used forever. They'd have to build out distribution. They'd have to achieve manufacturing scale. It's nearly impossible. In a recession, Procter & Gamble doesn't need growth to make money. The company just needs to maintain market share. And with the most trusted brands in their categories, maintaining market share is almost automatic. This is the kind of business where you can buy shares, collect your dividend checks, watch the stock go down during the recession, and then watch it recover as the economy improves. And after a few years of buybacks and dividend reinvestment, you'll own more shares than you started with. That's how you build wealth. The second dividend stock I would buy is Johnson & Johnson. Now, I know there's been controversy around Johnson & Johnson over the years, but let's focus on the fundamentals. Johnson & Johnson is not just a company. It's actually three businesses rolled into one. There's consumer health, which makes Band-Aids and Tylenol and Listerine and other products people buy at the drugstore. There's pharmaceuticals, which makes prescription drugs. And there's medical devices, which makes surgical equipment and diagnostic tools and other devices used in hospitals. Having three different businesses means that when one is struggling, another might be doing great. The diversification creates stability. Johnson & Johnson has been paying dividends since 1944. That's over 80 years of consecutive dividend payments. And like Procter & Gamble, the company has increased its dividend for over 60 consecutive years. Through every recession, through every crisis, the dividend grows. This is one of the most reliable wealth-building machines in existence. A person who bought Johnson & Johnson stock in 2000 and just reinvested their dividends would have made extraordinary returns by 2024, not because the stock price exploded, but because the dividend kept growing and they kept buying more shares with those dividends at different prices, some high and some low. The pharmaceutical business is where the real money is at Johnson & Johnson. The company makes drugs for cancer, for rheumatoid arthritis, for immunosuppression. These are drugs that people need to take for the rest of their lives. The pricing power is incredible because if you need a particular drug to stay alive, you're going to pay for it. The company spends billions on research and development to create new drugs. And once a drug is approved and on the market, it can generate profits for years and years. The beautiful thing about Johnson & Johnson is that it's not dependent on economic cycles the way other companies are. A recession doesn't stop people from taking their medications. A recession doesn't stop hospitals from using medical devices. If anything, the pharmaceutical business might actually do better in recessions because healthcare is non-discretionary spending. People have to take care of their health regardless of economic conditions. The dividend yield is around 2.5% and completely sustainable. The company generates over $30 billion in free cash flow every year. The dividend is covered multiple times over by earnings. This is a business where you can own it, collect your dividend checks, and sleep peacefully knowing that the dividend will almost certainly not be cut. The third dividend stock I would buy before the next recession is AT&T. Now, before you dismiss this, hear me out. AT&T has had some challenges in recent years. The telecom business is mature, growth is limited, but that's actually exactly why it's such a good dividend stock. AT&T generates enormous cash flow. The company has millions of customers paying month after month. That's recurring revenue. That's predictable revenue. The company doesn't need to innovate its way to growth. It just needs to maintain its customer base and optimize costs. And with a mature business, there's a lot of opportunity to optimize costs. AT&T has been paying dividends for over 30 years and increasing them for over 37 consecutive years. The dividend yield is around 7%, which sounds high, but it's actually appropriate given the maturity of the business and the predictability of the cash flows. The company generates over $35 billion in revenue every year. It's a massive business. The wireless business is stable because switching costs are real. If you've got a phone number you've had for years, a certain plan you like, devices you're familiar with, switching to a competitor is a hassle. So even in recessions, the customer base remains fairly stable. The debt situation at AT&T is something to watch. The company has taken on debt to fund dividends and buybacks in a severe recession. If cash flows decline significantly, that debt could become a problem. But assuming a normal recession where cash flows decline modestly but stay positive, AT&T should be fine. The company is also working to pay down debt and improve its balance sheet. So while AT&T is perhaps the riskiest of the 5 stocks I'm recommending, The dividend is substantial and has a remarkable track record of growth. The fourth dividend stock I would buy is Coca-Cola. Let me tell you why Coca-Cola is one of the greatest businesses ever created. The company sells sugar water. That's it. That's the business. But it's not really about the sugar water. It's about the distribution network. It's about the brand. It's about psychological association people have with that red can. Coca-Cola sells in over 200 countries, and the company has distribution relationships with retailers that have been in place for decades. In emerging markets where Coca-Cola is still gaining penetration, there's still growth opportunity. But even in mature markets where growth is slowing, the cash flow is absolutely tremendous. Coca-Cola has paid dividends for over 100 years. For 100 years, the company has increased its dividend for over 60 years straight. This is a business that survives and thrives through multiple economic cycles. The dividend yield is around 3% and very sustainable. The company generates over $10 billion in free cash flow every year, despite facing mature market growth challenges. Why? Because the business model is incredibly efficient. Once you have that distribution network in place, once you have that brand established, the margins are beautiful. Coca-Cola spends money on innovation and on marketing to maintain its position, but the core cash generation is remarkable. The competitive advantages at Coca-Cola are almost unmatched. The brand recognition is global. The distribution network took decades to build and cannot be replicated. The cost advantages from scale are significant. The switching costs for consumers are low individually, but collectively the brand loyalty is incredibly strong. When you're at a restaurant or a convenience store, Coca-Cola is almost always available. When you want a cola, Coca-Cola is the first thing you think of. That's the power of brand. In a recession, people might trade down from premium products to Coca-Cola, or they might cut back on coffee and opt for soda instead. The business model is resilient. The fifth and final dividend stock I would buy before the next recession is Duke Energy. Duke Energy is a utility company. I know that sounds boring, but boring is exactly what you want in dividend stocks. Duke Energy supplies electricity to millions of customers in the Carolinas, Florida, and Ohio. This is a highly regulated business. The company can't just raise prices whenever it wants, but the regulatory environment also protects the company from excessive competition. Customers can't easily switch to another provider. This is a network business where the capital intensity is high, but the competitive mode is also very high. Duke Energy has been paying dividends for over 100 years. The company has increased its dividend for over 35 consecutive years. The dividend yield is around 4% and very sustainable because utility cash flows are incredibly predictable. The company knows how much electricity customers will use. It knows how much it costs to generate that electricity. It knows how much the regulatory commission will allow it to charge. Given all that certainty, the company can commit to growing dividends because it understands its cash flows years in advance. The beauty of utility stocks in a recession is that electricity demand is somewhat recession resistant. Businesses still need power, homes still need power, and during the deepest parts of recessions, electricity demand might decline 10 or 15%, but it doesn't decline 50%. Meanwhile, the company's costs are somewhat locked in, so the profit margin might actually hold up better than you'd expect. Duke Energy is also investing in renewable energy and grid modernization. These are long-term growth opportunities that should support dividend growth for years to come. Now, let me tell you something critical about investing in these 5 dividend stocks before the next recession. You should not wait for the recession to start buying. That's a mistake. Trying to time recessions is a fool's game. Nobody can predict when they'll happen or how deep they'll be. If you sit on cash waiting for the perfect moment, you might miss years of dividend income. You might miss the recovery. Instead, what you should do is start building positions in these stocks right now. Today, buy some shares. You'll get paid a dividend. And then when the recession hits and the stock price goes down, you buy more. This is called dollar cost averaging, and it's one of the most reliable ways to build wealth over time. Let me be very clear about something, though. These are not get-rich-quick stocks. These are not stocks that are going to double in value in 6 months. These are slow, steady, wealth-building machines. A person who invested $50,000 in each of these 5 dividend stocks today, who reinvested their dividends, and who bought more every time the stock declined, would likely accumulate extraordinary wealth over the next 20 or 30 years, not because any one of these stocks is going to be the next home run, but because they'll compound, the dividends will grow, you'll buy more shares at different prices, the power of compounding will work its magic. I want to address something important. Some of you might be thinking, won't these stocks go down in a recession? Yes, absolutely they will. But here's the thing that most investors don't understand. If the business is good and the dividend is safe, the stock price going down is a gift. It's an opportunity. Imagine you were buying apples at the grocery store. You find an apple stand that sells premium apples that you love. The price is normally $5 per apple. So you might buy 1 apple per week. Then one day the price drops to $3 per apple because the market is nervous about apple supply. Do you stop buying apples? No, you buy 2 or 3 apples, you load up. The same logic applies to stocks. When a recession hits and the price of Johnson & Johnson goes down by 30 or 40%, the dividend is still going to be paid, maybe even increased. So you get a higher dividend yield at a lower entry price. If you buy those shares and hold them for 10 years, wait until the recovery happens. You're going to make extraordinary returns, not from the stock price going up dramatically, but from the combination of price appreciation during recovery plus all the dividends you collected and reinvested. I also want to address a psychological element of recession investing. This is where most people fail. When a recession hits, when you see your portfolio down 30 or 40%, when the news is filled with stories about economic doom, every instinct tells you to sell, every instinct tells you to get out, every instinct tells you to protect what you have left. But that's exactly when you need to be brave. That's exactly when you need to keep buying. The people who panic and sell during recessions lock in their losses. The people who stay disciplined and keep buying create generational wealth. Let me give you some specific guidance on how to approach recession investing with these dividend stocks. First, never invest money you might need in the next 5 years. Recessions can last longer than you expect. Stock prices can stay down longer than you expect. If you invest money you need for living expenses, you might be forced to sell at the worst possible time. Only invest money you can genuinely afford to leave invested for years. Second, invest incrementally. You don't need to put all your money in on day one. Buy some today, buy some more next month, buy some more next quarter. This way you benefit from dollar cost averaging. You buy some at higher prices and some at lower prices. Third, reinvest your dividends. This is critical. When you get your dividend payments, don't spend them. Buy more shares with them. This is how you turn dividend income into exponential wealth creation. Fourth, maintain some cash. The best deals come at moments of maximum panic. Having cash available allows you to be a buyer when everyone else is a seller. Fifth, don't panic and don't listen to the doom mongers. During recessions, the most bearish voices get the most media attention. People who predict total collapse become famous, but they're almost always wrong. Life goes on, businesses keep operating, markets recover, the companies I've talked about today will keep paying dividends. Let me also tell you what not to do during a recession. Do not sell your existing dividend stocks just because prices have dropped. If you own them at higher prices, they're even better values at lower prices. Selling locks in losses and denies you the opportunity for recovery. Do not try to be clever with market timing. Do not try to sell before the recession gets worse and buy back at the bottom. This sounds great in theory, but it almost never works in practice. You will sell too late and buy too early. Do not abandon your investment plan because of fear. If you had a sensible long-term strategy before the recession, that strategy is still sensible during the recession. In fact, is probably more sensible because valuations are lower. Do not listen to people who tell you to get completely out of the market and wait for the perfect entry point. The perfect entry point doesn't exist. Nobody has ever called the bottom of the market. You'll be waiting forever. Do not invest money you cannot afford to lose. This should be obvious, but it's worth saying. Recessions can last longer than expected. Stock prices can decline further than expected. Only invest money you can genuinely afford to leave invested for years. Do not concentrate everything in a single stock. Even wonderful companies can face unexpected challenges. The 5 stocks I've recommended provide good diversification. across different sectors. Do not use leverage. Do not borrow money to buy stocks. Leverage can destroy you. If you borrow to buy stocks and prices decline, you might face margin calls that force you to sell. At the bottom, here's something else I want you to understand. The 5 stocks I've talked about today are my choices. Your choices might be different. Maybe you find a different utility company with a better dividend track record. Maybe you find a different consumer staples company. That's fine. What matters is that you apply the principles I've outlined. Look for companies with long dividend histories. Look for companies that have increased dividends through multiple recessions. Look for companies that generate strong free cash flow. Look for companies with sustainable dividend yields. Look for companies with competitive advantages. If you find companies that meet these criteria, you'll do well regardless of whether they're the exact same companies I've chosen. The most important thing is to start now. Don't wait for the recession to begin investing. Don't wait for perfection. Start buying these stocks today. Start collecting your dividend checks today. Start reinvesting those dividends today. When the recession inevitably comes, you'll already have a foundation built. You'll have positions in place, you'll have dividends accumulating, and you'll have the courage to keep buying at lower prices because you already understand the value of these businesses. Let me be very direct with you about something. Building wealth through dividend investing is not glamorous. It's not exciting. It doesn't make for good stories at parties. But it works. It has worked for centuries. It will continue to work as long as markets exist. The compounding power of reinvested dividends is one of the most reliable paths to financial independence that exists. I have been investing for over 70 years. I have seen markets crash multiple times. I have seen recessions that felt like the world was ending. I have seen recoveries that surprised everyone. Through it all, dividend-paying companies owned by patient investors who kept reinvesting their dividends have created generational wealth. So the next time you see a headline about recession fears, remember what I've told you today. Remember the 5 dividend stocks. Remember the principles behind them. Remember that recessions are opportunities, not disasters. And remember that the people who get wealthy are the ones who buy when everyone else is selling. They're the ones who stay disciplined. They're the ones who let compound interest and dividend reinvestment work their magic. Over years and decades, your future self will thank you for the decisions you make today, but you have to act. You have to start. Knowledge without action is worthless. So I'm asking you, I'm urging you, make a decision right now. Open your brokerage account. Buy some shares of Procter & Gamble. Buy some shares of Johnson & Johnson. Buy some shares of AT&T. Buy some shares of Coca-Cola. Buy some shares of Duke Energy. Get started today. Don't wait for the perfect moment. The perfect moment is now. If this video has been helpful to you, if you understand the value of dividend investing before the next recession, I need you to do something for me. I need you to like this video. Hit that thumbs up button. Let me know that you found value in this content. And more importantly, I need you to subscribe to this channel. Subscribe right now, because I'm going to keep bringing you content about investing, about building wealth, about how to think like the best investors in the world. New videos every single week. So click that subscribe button. Don't miss a single upload. And if you want to be notified the moment I post a new video, click the bell icon and turn on notifications. Leave a comment down below. Tell me which of these 5 dividend stocks you're most interested in. Tell me about your own dividend investing strategy. Tell me about your long-term goals. I read every single comment and I respond to as many as I can. This is a community and I want to hear from you. So leave a comment. Start the conversation. The market will crash again. It always does. But you don't have to panic. You don't have to lose money. You can be ready. You can be prepared. You can be one of the investors who builds generational wealth during the next recession. It all starts with the decisions you make today. Thank you for watching. I'll see you in the next video.